Lo vamos a hacer con la ayuda de Lydia Boussour desde Oxford Economist. Lydia, hello, good afternoon. Thank you for attending us.
Hello, thank you.
Inflationary rates have been rising dramatically over the last year. We have seen both the CPI and the PCE inflation index increasing each month since October last year. The latest PCE released today shows high prices as well. How do you see it? Is it going chronic?
Yeah, so the data released this morning showed that headline PCE inflation, which is the measure that is the most closely followed by the Fed, increased again quite strongly in February. We saw headline PCE inflation rising by 0.6% month over month, and 0.4% for core PCE inflation, which is that key gauge that the Fed is watching. So we have right now headline PCE inflation running at 6.4%, which is very high, and core PCE inflation at 5.4%. These are elevated reading, and we actually think that there is more upward momentum. With surging food and energy prices, we're likely to see inflation rising even higher in coming months. So we are now expecting a higher peak in inflation and a slower descent in 2022, and that's a problem for the Federal Reserve.
Despite rising headwinds facing the U.S. economy, the upcoming jobs report tomorrow will again paint a picture of a strong and rapidly tightening labor market. What do you expect?
So in terms of the jobs report tomorrow, we're expecting a pretty strong gain of 550,000 jobs added. We're also expecting the unemployment rate to decline to 3.7%. So we're expecting, a job gain that was in line and the same tone as what we have seen since the beginning of the year. All labor market indicators are pointing to a tight labor market. Jobless claims fell to their lowest level since 1969. 2 weeks ago, they came back up a little bit. The data released this morning showed that they are holding around 200. So that's pretty impressive and historically low level. And we are seeing, a pretty strong momentum in the labor market right now. So that's going to be the message from the report tomorrow. I think a key factor that will be interesting to watch is what happens to wage growth. We saw a pretty weak reading for average hourly earnings last month. They were pretty much flat. So we are looking to see whether that was just, a blip in the data, or if it was more of a signal of a slowdown in wage growth. We think that that number likely understated wage growth. We are in an environment of tight labor market conditions, and we think that likely continued to push wage growth higher in March. So we are expecting average hourly earnings to regain some momentum and to rise by 0.4% over the month, and that should lift that annual pace back to 5.5%. That's very strong by historical standards. We are also interested in looking at what happens to labor force participation. That's also a key issue in the United States. We have still a pretty depressed level of labor force participation, and we have seen some upward momentum in recent months. So we'd like to see whether or not people have continued to rejoin the workforce. We do think that the labor force participation rate likely rose a little bit further in March. And we are expecting more labor supply coming back online in coming months, and that should help alleviate some of the upward pressure on wage growth, and that should also be reassuring in terms of the inflation risk and the inflation outlook right now.
Let's talk a bit more about the wage growth that you have just mentioned. How do you see salarial inflation? Because we should take into account this special moment, as you have described, the US labor with a lot of vacancies and employers paying more in order to attract workers.
Yes, so labor market conditions right now are very tight. We saw labor job openings, remaining above 11 million for a third straight month in February. And we have right now a lot more job openings than unemployed workers in the United States. So that's an issue that is, keeping upward pressure on wage growth. Now, there were a number of factors that have been holding back the supply of labor, and some of these factors have been dissipating. The key factor has been the pandemic, and we know that some workers have been fearful of rejoining the workforce, especially those working in high contact services industries. So here, with the improvement in the public health situation, and also the fact that people are vaccinated, we're seeing people, rejoining. The other key issue is childcare, and on that front as well, we have seen school reopening, and that should also help some parents and some women to rejoin the workforce. Although that will be that will take some time. And lastly, there is also the problem of the retirement of baby boomers, and that structural downtrend that was still in place already before the pandemic, and that remains in place right now, and that's pulling down the labor force participation. But we do think that some of these constraints have been easing, and that should alleviate some of the pressure on wage growth in coming months. It doesn't mean that the labor market will loosen significantly. We will remain in a tight labor market, but some of the excess pressure is likely to be slowing and cooling in coming months.
Okay, so a positive view about this topic. And finally, what will you think that the Federal Reserve is going to do? Is going to give us a 50 basic points rate hike in the meeting of May?
Yeah, so we've heard from Fed officials over the past week. They're really willing to lean more aggressively against that inflation risk, and given the inflation shock that the economy is experiencing right now, they're really determined to bring down inflation. We do think that the Federal Reserve will actually raise rates by 50 basis points in May. We are also expecting another 50 basis point rate hike in June, and we're expecting a total of 200 basis points of rate hike for this year. It is a very delicate rebalancing that the Federal Reserve will have to achieve this year and next year, and it will be a pretty bumpy ride for the U.S. economy. We know that the economy right now is facing rising headwinds from rising inflation, but also is not benefiting from fiscal support anymore, and will face tighter financial conditions. So it is certainly a challenging backdrop for the Fed as it tries to engineer that soft landing.
So, Lydia Boussour, desde Oxford Economics, thank you so much for your time. Have a nice day.
Thank you.